We'll just give it one more minute. We do still have some attendees joining. We'll get going in just a moment. Okay, in the interest of time. Good afternoon, everyone. Thank you for joining us at this time and in this new medium. I hope that you and your families are all doing well and coping. My name is Phil Boglevsky, and I am the wealth planner with Libro Credit Union. Our original moderator, Paul McQueen, the VP of Wealth, was originally scheduled to host this session. Unfortunately, Paul has fallen under the weather, and therefore you get to listen to me. As part of Libro Wealth Management, I have the privilege of working with our wealth team across the credit union, including our financial advisors, financial planners, and account managers, providing financial planning and investment services directly to Libro owners. I would like to welcome you to Libro's second installment of our webinar series, where we have the opportunity to introduce and learn about various topics that may have a significant impact. And I don't only mean topics that deal with tax, corporate and legal structures, insurance needs, or estate planning. Of course, we talk about all these things. But as Libro's business model is based on purpose, which is supported by our why statement, in that our mission is to grow prosperity in Southwestern Ontario, and that we want to grow your prosperity by using our business force for good, our webinar sessions and events in general are about helping individuals and Libro owners understand, address, and deal with factors that affect your financial well-being and that of your families. So once again, I would like to thank you for joining us today and welcome you to Libro's webinar on the individual pension plan. Today's session is being recorded, and you will be able to reference it, as well as our other recorded and upcoming events on the libro.ca website under the About Libro banner and selecting events. Please notice the chat function available to you on our Teams Live feature, and feel free to add questions and comments during the presentation. We may not address or publish every question or comment, but we'll certainly look for some themes or common questions. You can choose to post anonymously if you wish to maintain privacy with your questions. That being said, we would suggest that if you do have a very specific question for your own personal situation, that it may be best served in a one-on-one situation with one of our Libro coaches after the event. We're very excited to have our guest speaker here today, Doug Carroll. Doug Carroll is a tax and estate specialist with Aviso Wealth. Aviso is a national integrated financial services company serving the wealth management needs of virtually all of Canada's credit unions, including Libro, as well as a range of independent financial organizations. Aviso is the parent company of our investment dealers, Credential Asset Management and Credential Securities, that some of you may already have accounts with. Doug has held many roles in the life insurance and investment industry at both the supplier and distributor levels, combined with real-life experience running an estate planning law practice. Doug has written and published many articles, held financial industry speaking engagements, and contributes to and has been quoted in the financial industry media, including the Globe and Mail, National Post, Toronto Star, BNN, CTV, and the list just continues to go on. Doug holds a bachelor's degree in business administration, a Juris Doctor, the equivalent of the LLB or law degree, and Master of Laws with a specialization in taxation. He is also a trust and estate practitioner and a certified financial planner, and previously sat on the board of directors of the Financial Planning Standards Council, now FP Canada, the overseeing body for CFP professionals in Canada. Professional qualifications aside, Doug gets the greatest satisfaction when people say he actually speaks English when he speaks law. With that, I'm going to turn it over to Doug.
Okay, Phil, I just had to unmute myself. I think that I'm audible now. Give me a thumbs up if you can hear me, and I know that I'm going out to the world here. Okay, and that last point about speaking English is an important point, particularly in this topic, because individual pension plans are pretty complex. They actually are their own topic dealt with on a lot of the professional conferences, including one of those organizations that Phil mentioned, the Society of Trust and Estates Practitioners. There's an entire panel that gets devoted to that on the annual conference each time, not every year, but quite often as a breakout session among these people who deal with tax and estate and financial matters, to look at the latest developments in individual pension plans. And just to lay a little bit of the groundwork here of why this is a particularly interesting or timely topic in terms of today as relative to maybe about 3, 4, 5 years ago. There were some significant changes just a couple of years ago with the taxation of corporations, and particularly with taxation of passive income inside of corporations, and the danger that that poses to the corporation's ability to make use of the small business tax rate. That then has led to a resurgence in interest in a variety of ways that business owners may be able to adjust in response to those tax changes. And an individual pension plan is one of the types of approaches that is particularly helpful if you qualify for it, if you're comfortable with it. So what we're going to do here is we're going to do a high-level overview. As I said, it's a very complex topic. It involves making sure that your accountant, from a tax perspective, sees it as an appropriate approach for the broader issues of running your business, as well as your financial advisor from the personal side sees it as delivering in terms of what you need on the personal side of your savings and your retirement needs. And then in between, you've got the need for an actuary who will help out in determining what it is that you can do with the individual pension plan, as in how much can be placed into it and what kind of obligations on the other side of it your corporation that you own will have in funding the individual pension plan. So we've got 8 topics that we're going to go into here. We don't have a ton of slides that I'm going to go through. Happy to, again, hear the any questions on the chat that we can deal with. If they get a little bit too personal or just would get too complex to deal with in this kind of forum, then we can do follow-up on those things. But we'll work with these topics here. And there's not a ton of text on each of the slides that I'm going to take you through, but a half dozen topics on most of them. So I'm going to walk you through these issues to give you an idea of what we have in terms of the use of an individual pension plan. So the starting point is the concern of having high tax in corporations. The small business tax rate is across the country. It varies a little bit, but it's in the low teens, somewhere in the 10 to 12% area, 12% in Ontario, for the small business rate. But if you get up to the corporate rate, the general corporate rate, you're into the mid-20s or so, 26.5% combined between federal and Ontario, here in Ontario. And so if, as you're running a business, you want to get as low tax as possible, then you would rather have the small business rate than the high general corporate rate. And as I mentioned, the changes in the tax rules a couple of years ago with passive income portfolios, if you have too much passive income in your investment portfolios inside of your corporations, then you can lose the ability to get the small business rate and be pushed up into that high tax bracket area. So the use of an individual pension plan, funding an individual pension plan, and your corporation then making tax deductible contributions into it can place money into that structure rather than continuing to be invested inside of your corporation in a portfolio that is held directly by your corporation. So that's the concern that we're working with, is the high tax rate that applies in corporations. And as well, you as an individual, an entrepreneur and a successful entrepreneur are at a higher tax bracket than the average person, and likely nearing the highest bracket, up at 50%, 53.5% in Ontario. So you don't want to be taking money out of your concern of your high tax corporation just to take it over into your direct hands and be subject to high tax yourself. So making use of retirement savings vehicles like an RRSP and then comparatively an individual pension plan allows you to get the deductibility from the corporation on making those contributions, and then not having that income being taxed to you personally. In terms of RRSPs, we do have rates that apply, the maximum rates that apply for RRSPs for the ability to contribute into those plans, which is 18% of your previous year's earned income. So in the current year, your ability to contribute into your RRSP, or the room that you are entitled to, that you have credit for in 2020, is based on the income that you had in 2019. So 18% of the 2019 earned income gives you the entitlement that you have to put into an RRSP in the current year, which is about $27,000 in this year in 2020, and that's based on about $150,000, just over $150,000 of earned income back in 2019. So what we can do with an individual pension plan is, rather than having those firm percentages that apply with RRSPs, where it is a type of retirement plan which is called a capital accumulation plan, that's the category it's in, where the amount you can put into it is what is defined. With an individual pension plan, it is instead the amount that can take out of it. It's called a defined benefit plan, where you as the plan sponsor, the employer that sets this up, will have an obligation to pay out that pension at a later point in time to the person who is the pensioner, and you as the owner of the business, with a different hat on, are the pensioner as well as the owner of the business here. So you will have the obligation to, as the corporation, to make those payments, and then you personally, as the pensioner, will receive those payments out of the plan. So you want to get as high a deduction as possible if you can, and that's what the individual pension plan structure does. Because of the defined benefit nature of it, the amount of contributions that can be made into the plan is larger with an individual pension plan than it is with an RRSP, at least after you reach a certain age. And I'll give you the rough figures of when that applies. So it gives you more flexibility with what you do with your retirement savings. Gives you the opportunity to take your retirement savings and get larger accumulation in it, another place where you can have your money in addition to having it inside your corporation. And at a later point, when you retire, you're able to make choices about how it is you're going to take that pension, whether it's going to be something that you take as an annuity, whether you take it as the pension as defined in the paperwork for the pension itself, or maybe you commute that into a locked-in registered plan, and you'll have a lump sum of cash, some of which will be subject to tax, which then gives you, again, more flexibility of how you're going to take that money out. So, oops, wrong way, sorry. So ideally, the ideal candidate for this kind of arrangement, you need to have an employer-employee relationship. So you need to have a corporation in order to do this. If you have a sole proprietorship, particularly if you're a professional who has operated under a sole proprietorship, you may very well have had a very successful career and substantial earnings, but you are not an employee of yourself in that case. The sole proprietorship does not qualify for using an individual pension plan. There needs to be that formal relationship between employer and employee. So we have corporation that needs to be in place in order to make use of an individual pension plan. The age that you would look at setting up an individual pension plan, because of this actuarial calculation that applies to the defined benefit of what's going to be received on the receipt of the pension later on, the calculation compared to what happens with RRSP room, 18% of the previous year's earned income, there's a crossover point where you can get more contributions into an IPP at about age 38, and it gets increasingly larger as you go beyond age 38. It becomes very significant and noticeable once you get past age 50, but you can't set up an individual pension plan any later than age 71. It has to be in place by that point. That's when it starts being drawn down or forced to be drawn down. You need to have employment income for the money to go into an IPP. Past income is going to give you the ability to contribute in to get it going for past service. Even if there is not a significant amount of past service, you do need to have employment income on an ongoing basis in order to gain room that will then both entitle and require contributions into the pension plan. We're looking at someone who is at a high to top tax bracket, and generally, for simplicity, sometimes it's referred to as over 100,000 because it's a nice round figure that that might be applying. But it's probably beyond just breaking through that $100,000 level. You'll need to have an actuary doing the calculation for the amount of money that can go into the pension plan. But just in terms of your thinking process, be aware that it does need to be north of $100,000 generally in order to be beneficial to set up an individual pension plan. And ideally, you're going to have a consistent income. There is a legal obligation on your corporation to make the year-to-year contributions. So if you have income that goes up and down all over the place, or if you have significant liabilities that make cash flow a problem with the type of business that you run, then that can be difficult to maintain those payments with the individual pension plan. So consistency is something which is helpful in terms of being able to keep in line with the legal requirements to fund the plan. So the main features that we have with the pension, the individual pension plan, is that it is a defined benefit plan. And I've already given you the comparative definition of that, of what happens with an RRSP that most people are familiar with. With an RRSP, we know, or we can determine how much can go in. What the IPP is, it is a registered pension plan with a defined benefit component. Most of the rules actually are the same for an IPP as they are for the really large registered pension plans that are available through employers that provide defined benefit plans. The difference, though, is you can't have, or one of the key differences here is, you cannot have more than 4 members. In fact, it's less than 4 members. It's 3 or less members who are part of the individual pension plan. It doesn't have to therefore be one individual pension plan. It has to be less than 4. But depending on how you're going to use it, you may want to have just one person on the plan. Usually the extension of the plan is out to other people in the family, perhaps, who are involved in the business enterprise that might also be part of the individual plan. So in order to do this, then you can't have you can't have people who are not at arm's length from the plan as members, and the requirement for the rules that apply under the individual pension plan, which does have more flexibility than registered pension plans that are for large numbers of people, is that the person who is the connected person to the corporation has at least 10% of the shares, the voting shares of the corporation. So what it does is, because of the actuarial calculation, the amount of pension that you're entitled to receive can be fairly generous, rather than just being stuck with, and I say that with due respect to the RRSP rules, but rather than being part of strictly a financial calculation that applies to everyone under the RRSP rules, what the actuarial calculation does is it takes the entitlement that you decide between your corporation and you as the pension member, what kind of a pension you will be entitled to in your later years. So you can be very generous on how you do that. You could determine that taking the extent of what the tax rules allow you, you could give the most generous plan to yourself as possible in the paperwork, in the documentation, so that your corporation as the employer has a very large obligation to make sure that you get paid that in your retirement years. So that may be that you are going to determine that the appropriate amount that you're entitled to under the plan will be your top 3 income earning years. Whereas some pension plans will take the average of 5 earning years, or it might be your last earning years. But you can make it as positive as possible within constraints. You can't go outside of the boundaries of the rules, but you can make it very very generous to yourself the way that you set up the plan. When you set up the plan, the fees involved in doing it are deductible to the corporation as the employer when it is being set up. Another point here that's an important distinction between the individual pension plan versus RRSPs is that there is generally a higher level of credit protection that is entitled to registered pension plans. Again, IPPs being a subset of registered pension plans. There's a higher level of creditor protection associated with that, and particularly where you're talking about excess money in the corporation that you reach the end, or you reach the limits of putting your 18% of your RRSP money in. If that money remains inside your corporation and is invested inside your corporation, then should you run into some problems with creditors of your business, then those creditors may be able to go after the money that's in the corporation. And similarly, if you dividend that out to yourself personally, those creditors, if there are personal creditors, may be able to go after your personal assets. But if you have an individual pension plan, it has a very high level of protection against creditors being able to go after those funds. So in setting up the individual pension plan, funding it, putting a substantial amount of funding into it, you're taking money that otherwise would have been general corporate money or personal money that now is inside of this structure, which serves the pension purpose, but additionally has additional creditor protection associated with it. You also have the possibility of doing income splitting more so than may apply with an RRSP. And that's because when money is paid out of a registered pension plan, the income splitting rules, the pension income splitting rules, allow for up to 50% of pension income that is received by a pensioner to be transferred over to a spouse. With RRSPs, when you take the money out of an RRSP, you will generally convert that into a RIF, Registered Retirement Income Fund, and the amounts that can be split under a Registered Retirement Income Fund are only available for splitting after the age of 65. But under the individual pension plan, as long as the amounts are paid out as life annuity amounts, then those are allowed to be split with a spouse. So you can do it at an earlier age yourself to be able to split over to a spouse. Gives you more options there. The next item is that you can replenish shortfalls, which is something you can't do with your RRSPs. With an RRSP, if you have had a little bit of a bump in the road with your investments where things did not go as well as you wanted to, then you can't put more money into the RRSP. With an individual pension plan, there are rules of how much must accumulate in that plan based on prescribed rates. It's actually based on a 7.5% return, which is expected in that plan. So if over the course of a number of years you've had less than those types of returns on your investments, then you are entitled as the employer, as a corporation, you are entitled, and in fact you are required as the pension plan sponsor to make further contributions in the plan to top it up or replenish those shortfalls. And then the last item that I'm showing here is managing the tax on split income. One of the things, TOSI as it's showing here, one of the things that was included in the changes to the tax rate, the corporate tax treatment a couple of years ago, was to extend out the tax on split income, the TOSI, beyond just minor children and over to adult children and spouses. And the tax on split income, basically, it causes payments, certain types of payments made to close family members, to be taxed at top tax bracket rather than taxed at the tax bracket of the individual, depending on your corporation and where the money originates from your corporation and your relationship with that person. So when you pay out a dividend to a spouse who is not involved in your business, then potentially the dividend does not get taxed at your spouse's tax rate, presumably a lower tax rate, and that's why you're doing that, but instead gets taxed at the highest bracket rate. But with the use of an individual pension plan, again, when payments are paid out of the individual pension plan, you have that ability to then split over, using the pension splitting, over to that that spouse, so you can manage around the otherwise application of the high tax rates that apply under the TOSI rules. Oh, going the wrong way. Sorry. So, although I've positioned this as an ability to put more money into registered savings, it's not simply a matter of a bulked up RRSP, like a bigger RRSP. There definitely is more involved in terms of the paperwork that has to support it. There are additional filings that are involved with the Canada Revenue Agency in order to make sure that you are compliant with the rules and with the pension benefits rules as well. So there are those annual filings. And then there is something called the triennial test. This is the test that is applied by an actuary to look at the accumulation in the plan versus what is required based on the expectation of the pension to be paid to get to the point of being able to pay that pension. So every 3 years, you have to have an actuarial review of the plan to determine whether you are keeping up or falling behind the requirements of the plan to pay that later amount. So that is something which adds an additional cost. So in total, all of these expenses, as a rough figure, and depending on who the pension consultant may be, they may suggest they can do it a little bit differently, but keep in mind something in the range of $2,000, so $1,000 to $2,000 per year on average. That will be additional cost of making sure that the compliance rules are complied with. So starting up the pension, one thing that people ask is, well, where does the money come from? And there's actually three places that the money comes from to start up the individual pension plan. So having determined that you do have an employer relationship, you do have a corporation as the employer and individual yourself as the employee, then the determination has to be made of how much money can go into the plan to start up. And that's what's called your past service contribution. And there's three sources for that. Once the actuary has determined how much can go in, then they're going to look first to what are your existing RRSP holdings, and that's going to be used to go into the individual plan, the individual pension plan, to transfer into the plan. Secondly, there would be available RRSP room that you have not yet used, that you would be required to then contribute money in and use some of your RRSP room in getting the next component. And then thirdly, the corporation itself can make a contribution into the plan, which will be a tax deductible contribution. So the other two items are contributions of RRSP money in the first place, or in the second one, placing money into an RRSP, which then goes over into the individual pension plan. So if additional money is placed in, then there will be deduction to you personally. And then the third one is a contribution by the corporation itself to make up the difference. There we go. So that's the past service component. The establishment of the IPP then has happened. You've got it going, and then on a year-to-year basis, the employer, the corporation, will have to make its annual contributions, and then you continue on doing the business that you do. When you get to the point where you are going to retire, and when I say retire, I don't mean that you are necessarily ceasing employment. You might continue to work, but when you make the determination that you no longer want to keep the pension plan in accumulation mode, then there is a possibility of making what's called a terminal contribution. So once again, there are rules, there are constraints on what the actuary must work with in determining the amount of funding that can go into the plan. Those rules, I'll give you just one as an example of one of the rules. You have to assume that the person is going to retire at age 65, and so the money in the plan must accumulate until that age. But let's say that you made the decision that you're going to retire or stop funding the plan at age 60, and you're going to start taking your pension at that point. Then that's different than the required age 65, that there would be continuing contributions as you continue to work and your employer made those year-to-year contributions. So because there is that gap between age 60 that you've made that decision and the underlying assumption that's been operating for the actuary that it would be age 65, then there may be an opportunity for your corporation to elect to make a further terminal contribution into the plan to make up for the fact that those next few years will not get contributions because you're not continue on with the accumulation of the plan in your working years. So there are a number of assumptions which then at the point of initiating the plan, which may contribute into that, but that's probably the easiest one to get your head around is if you retire earlier, retire being ceasing work or ceasing the plan, not ceasing work. So that's the one that probably is the clearest one in terms of the ability for your corporation then to elect, not obligate, but to elect to make a terminal contribution into the plan before you start taking that retirement pension. And then when you get to payout time, then there are a few ways that you can take your pension. The first is simply that you go ahead and take the pension according to the terms of the plan itself. So it's written into the pension plan that you're going to receive a pension based on a particular formula. You could just do that. Just allow it to pay out the pension according to what's in the paperwork that you put in place. Alternatively, what you could do is take the funds that are there inside of the plan and use that money to purchase an annuity, which would then pay you an annual amount. So it may be that provides you with a preferred return by engaging with an insurance company and purchasing annuity, giving them a lump sum to the insurance company, and then the insurance company paying the annuity payment on a year-to-year basis thereafter. And then the third alternative, which is probably the most common one that is at least contemplated, if not executed this way, but generally I think this is the direction that most people would expect to go and do in fact go to, is that you would commute the pension. So when you get out to that point in time, just as you can with defined benefit plans that are not an individual pension plan, you have the ability to commute the pension into a lump sum amount. And when you do that, a certain amount of that money that is commuted will be able to transfer into a locked-in RRSP and then eventually be paid out as a locked-in registered income fund. And then any excess amount which cannot go into the locked-in plan would then be what's called an excess amount, and it would be taxable. Not a happy event, perhaps, but you've been able to accumulate a larger amount through your individual pension plan. And then if you make the decision that you're going to then commute it into a single amount, you're then back into a position where, in concept, you are transferring back into a locked-in plan what you would have accumulated using the RRSP or the defined contribution type rules, and the excess amount is gravy amounts that have accumulated to your benefit. But again, you're going to face the taxation on that. It just depends on what your intentions are with your retirement, which of these choices you make. And particularly if you have family members who are also members of the pension plan, it might not be such a bad thing for you to perhaps take the pension per the plan. And if you do not draw out your full pension that has been accumulated there, the pool of money that's accumulated there, then the remaining amount, the surplus, could remain inside the plan to be paid to those other pension members, which in my example here are your family members. So you're able to work with that to try to share the wealth in a way which is legal and has to be within the rules, gives you a little bit more opportunity. Now at age 71, you might say, well, I want to keep on going with this thing forever. But at age 71, you do have to start taking the money out of the plan. And effectively, it's the RIF minimum rules that apply from age 71 or after age 71 and onwards. And I already mentioned the point about the surplus. What happens to the surplus if you were going to take the pension per the plan, and you leave money behind? Then the other members of the plan will receive that. Now, if there are no other members of the pension plan, if it's just you, then it will either, the money that's there will either go to your estate. It may go as a continuing pension to your spouse if you've set it up that way. It may go back to your own corporation. But it's not, the key thing here is it's not going to be lost. It's not going to completely disappear. It's not forfeited to the government, for example, if you have surplus in there that is not paid out at the point of your death. So that, Phil, that's as far as I've got my content that I've run through here. I'm going to bring up the agenda items here, and if there are any questions that have come up, then we can address those questions. But for now, I'm going to turn it back to you if you want to pick it up from there.
That's great. Thank you, Doug. That's a lot of great information. And I did want to reemphasize for everyone on the webinar that the session is being recorded. So if you miss some of the details that have been discussed, it will give you an opportunity to come back. Doug, there are a couple questions that have come across, and I'll pose them to you if you will. Are the expenses and annual fees paid to establish and maintain the IPP tax deductible to the corporation?
Yes. So the fees are deductible to the corporation. It's the fees in establishing in the first place, which are usually the largest amount that as a bulk to get things going. Those are deductible. And then on a year-to-year basis, the maintenance of the plan I mentioned, and I will leave it to the administrators of these plans to quote their own fees. But I said, just keep in mind that there will be some fees that will be associated with the paperwork, so up to around $2,000. Now, one of the things that I did not mention is that you also can get deductibility for borrowing money to place funds into the individual pension plan. Now, that doesn't apply if you were going to borrow personally to put into your own RRSP, for example, an RRSP loan. But where a corporation, which is obligated under the terms of an IPP to fund the IPP, when the corporation borrows in order to do that, then the interest on that borrowing is also a deductible expense to the corporation. So it's another way that you can get a deduction, but for very good reason, to get one of these things set up, so that you can have, again, more flexibility with what you do with your retirement savings.
Okay, great. There is another question that I have for you. Does Libro or Aviso have access to, or could you recommend an actuary who would be able to set up such a plan?
Yeah, so I obviously I can't speak on behalf of Libro. That's your you can step in on that one, Phil. On behalf of Aviso, we keep connection with actuaries that do this kind of work. So we don't, or Aviso does not do the actuarial work, but there are professionals. That's an actuarial firm is a consulting firm that deals with actuarial calculations for a variety of things, but particularly for pension type calculations. And so we can give a referral over to pension plan administrators who do this kind of thing.
Great, great. Thank you, Doug. So I guess there is something to be said for, again, working with Aviso and as part of the credit union system. So there are no other questions that are in the queue at the moment. So I would like to thank you and thank everybody for joining us today. We really do appreciate your time and attention to this conversation. I would like to remind all of our owners and future owners that all of our regions and all of our branches have access to accredited financial planning professionals and experienced coaches who can help with these questions and conversations. We also are going to include 29 responsible investment specialists on this front. We have dedicated coaches to work with anyone, and that's owners who are just getting started to business and farm owners with incredibly complex situations. We have the expertise, the capabilities, tenure, and experience within our Libro team, and we are prepared to help with all of your questions, a lot of them best served at an individual level. You will be receiving some follow-up information today following the conclusion of our presentation, including an article on the individual pension plan strategy itself. Doug, before we sign off, wondering if you have any final words of wisdom.
Well, I don't know so much words of wisdom, but I will say that, as I said, we can get you in touch with pension plan administrators, actuaries, and the investment management of the funds still can be handled by your Libro advisors. You're creating the structure with an IPP that is different than a registered retirement savings plan, but you can still engage the advisors who you want to provide you with a recommendation on the investments. So it adds a layer that gives you a little bit more complexity, a little bit more opportunity, but preserves your ability to choose the advisors who you wish to work with in terms of the investment choices that you make.
Wonderful, wonderful. Thank you, Doug, and everyone for joining the webinar. Once again, the call is being recorded and will be available on our libro.ca website. Thank you. We hope that you've learned something today, and we look forward to talking with you in the near future. Have a good evening.